Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today is Tuesday, December 8th, 2009. Today's session was characterized by higher risk aversion as we saw renewed credit woes, especially surrounding Greece and the UK. Plus we had some weaker fundamental data from Germany and the UK, as well as a slide in US stocks and commodity prices such as oil and gold. Fitch Ratings cut Greece's credit rating to BBB plus today from A-, which is the third lowest investment grade, as the country's finances deteriorate and it may struggle to meet its debt commitments. Stocks and government bonds in Greece tumbled on the news. The news also increased risk aversion in European markets and helped the greenback to extend its gains against the euro and others. The pound, meanwhile, was pressured overnight following a warning from Moody's Investors Services that the UK credit rating was weaker than top-rated peers, including Germany and France. Both the UK and the US need to rein in their deficits in order to hold on to their AAA ratings. We had weaker industrial production data from both Germany and UK that we will take a look at, and all of this overnight risk aversion hurt investor sentiment in US markets as US stocks slid around 1.25% in today's trading, at least the Dow Jones did, and gold prices fell another $21, and oil was off $1.30. All in all, these fundamental pieces of news helped both the greenback and the yen gain as safe haven destinations. As we see here in the euro-dollar pair, the greenback gained around 180 pips from high to low in today's trading. In most of November, we had been bouncing between the 1.48 and the 1.5150 area, with a smaller level of resistance around 1.5050. But this week has been the first time that we have breached the 1.48 area, as we did in yesterday's trading, and following a counter rally, we did so much more decisively in today's trading. Today's low is a 1-month low for the pair and comes on the back of an increase in demand for the dollar as a safe haven. We saw last Friday the non-farm payroll report strengthened the greenback, but this time it's a more common theme of risk aversion helping the greenback. German industrial production slid unexpectedly in October, with output contracting 1.8% following a 3.1% increase in September. Expectations had been for a 1% increase. It's the first time in 3 months that output was down, and the decrease was led by a drop in production of both energy and investment goods. On the year, production declined 12.4%. With government stimulus measures running out, the test will be if the recovery in Germany and the rest of the Eurozone can be self-sustaining. Factory orders, for instance, fell for the first time in 9 months in October, as we saw the pace of restocking wane. Still, October's figure could be a correction to the rather strong reading we saw in September. The UK also saw its manufacturing production come in weaker than expected, as the monthly change was flat in October, and the annual pace saw a 7.8% decline, which was an improvement compared to the 9.8% decline we saw in annual terms in September. This flat reading shows that the economy is struggling to shake off its recession, and we'll see if here too we are correcting a strong reading in October, so next month's data will be rather important to gauge the manufacturing activity in the UK. The pound-dollar pair, which we're looking here in 4-hour candles, extended its declines from the 1.67 area it reached last Thursday. From around its open near 1.6475, we slid at almost 200 pips from high to low, and today's support runs up against a long-term level of support that goes back to mid-October. We mentioned this in our morning brief, and following a break of this 1.6275 area in mid-October, we tested it as support twice in later October, again in late November, and now one more time. So a break below this level could spell some serious bearish pressure for the pound. We have some good technical analysis articles about this pair on fxtimes.com, so head on over there to see more of a technical picture. The yen was a strong performer today on the back of risk aversion, and here in the pound yen pair we see a rather sharp slide from the 147.25 area to open today's trading all the way down to 143.78. So that amounts to about 360 pips from high to low. Following our breakdown in this pair in mid-November, following some consolidation ranging trading here, we broke this level around 149, and following our slide in late November, we retested that level to start this week, or to end last week, and we've seen the pound bounce down off of this resistance level rather strongly, and we've retraced more than 50% of our rise here in the pound. If we zoom in to show more recent price action, we see that we had a zone of resistance here around 143.80 that had acted as resistance during this bottom, but is now being tested as support in today's trading. So we'll see if this level holds, but if our level in the pound dollar is broken on the bearish side, we could expect to see this to fall in favor of the yen as well. Similarly, the dollar-yen pair fell in favor of the yen, with the pair retracing all of its gains from Friday's session in the non-farm payroll report. We had a break of this upward sloping trend line in today's trading, and we returned back to the level where we were consolidating in November 20th through the 24th. If we extend this trend line, we see that it had acted as resistance prior to our break from the non-farm payroll release, but now it is acting as support in today's trading. Moving along, we saw the Bank of Canada hold interest rates steady at 0.25% today, which matched expectations and matched the bank's conditional commitment to keep rates at that level until the second half of 2010. They reiterated that promise in their statement. The statement overall struck a bit of a neutral tone that said that while there are still significant headwinds remaining, global economic developments have been slightly more positive and the global outlook has improved modestly relative to its October forecasts. The bank also softened its language regarding the impact of the stronger Canadian dollar. In its October meeting, the bank said that the current strength of the Canadian dollar could more than fully offset the favorable developments in the economy. In today's statement, the bank said that the persistent strength of the Canadian dollar could act as a significant drag on growth and put additional downward pressure on inflation, but overall it was a softer tone taken in regards to the Canadian dollar. The Canadian dollar was weaker against the Greenback today, as Greenback rallied from around the 1.05 area to start today's trading to trade near 1.0670 at its high. That broke a bit of an upward sloping trend line, and it continued the theme we've seen in this pair, which has been a range trading between 1.0450 and 1.075 that we've seen throughout most of November. So we'll see if the pair wants to retest this resistance level in this week's trading, especially if risk aversion and Greenback strength prevails during the rest of the week. As we can see, if we zoom this pair in a bit, we have been steadily rising in favor of the Greenback as we've set some higher lows and some higher highs in the past 5 sessions. Now let's take a look at upcoming fundamental releases for the next session. Tonight, Australia will post its data on consumer sentiment, on home loans, and its trade balance. The UK will post data on consumer confidence and shop prices, and Japan will post its final version of third quarter GDP along with a measure of machinery tool orders. Overnight, Switzerland posts its unemployment rate, and then both Germany and the UK reveal their trade balances. Tomorrow, the US just has one release, wholesale inventories, while at 3 p.m. Eastern Standard Time, the Reserve Bank of New Zealand will decide on interest rates and put out its statement. And that will wrap up today's broadcast. For more news, analysis, and videos, including today's technical update video recap, please visit our site fxtimes.com. Thank you for watching, and happy trading.